Do you know the secrets that make Australia one of the best places to explore? Let's uncover some amazing Aussie super secrets. And you won't even get a thank you note for your generosity. If you are over 45, have a balance of $300,000 or more in your super, and haven't checked your contribution levels in the last 72 hours, you are effectively leaving a luxury holiday or a brand new car on the table for the ATO to snatch away. Welcome back to Aussie Super Secrets. Today, we are entering the final countdown for June 2026. We are deconstructing the exact tactical moves you must execute before the clock strikes midnight on June 30th. To secure a massive tax saving and supercharge your retirement balance. By the end of this deep dive, I will reveal a lethal $16,500 compliance trap that is currently catching out high-income executives across the country. You cannot afford to miss this. But before we sharpen our scalpels, a mandatory reminder for the room. This is general information only and does not constitute personal financial, taxation, or legal advice. Always consult a qualified professional, specifically a licensed financial advisor or accountant, before moving your money or making investment decisions. Let's talk about the $30,000 threshold. For the 2025 to 26 financial year, the concessional contribution cap has been indexed to $30,000. If you are still thinking in terms of the old $27,500 limit, you are already falling behind. For a high flyer in the 45% marginal tax bracket, failing to maximize this cap means you are paying nearly half of every extra dollar in tax, instead of keeping it in your own name. Imagine David. David is a senior partner earning $220,000 a year. His employer pays the standard super guarantee, but David hasn't looked at his salary sacrifice arrangements in years. He's bleeding cash. By failing to use the full $30,000 cap, he's missing out on the 15% tax rate inside super, and instead paying 45% plus the Medicare levy on that income. That is a 32% difference in net wealth every single year. It's madness. But do you know what is even worse than missing the cap? It's the BPAY death trap. Most Australians think that if they hit send on their banking app on June 29th, they are safe. They are wrong. We will see why that administrative lag is the ATO's best friend in just a moment. First, let's look at the carry-forward secret that most industry funds don't explain clearly enough. If your total superannuation balance, or TSB, was under $500,000 on June 30th of last year, you have a financial superpower in your pocket. You can reach back over the last 5 years and scoop up any unused concessional cap amounts. This is how we reach that $12,450 saving figure. If you've had a year with lower contributions, you might have an extra $50,000 or even $80,000 in catch-up capacity. By making a large personal deductible contribution now, you can potentially wipe out your entire tax bill for the year. But you must be surgical. If you go $1 over your limit without checking your carry-forward balance on the MyGov portal, the ATO will come knocking, with excess contribution penalties that can reach 47%. But wait, there is a massive shift happening right now with the Stage 3 tax cuts. Even with the new tax brackets, the 15% tax environment of superannuation remains the ultimate tax haven for Australians. If you are currently sitting in a MySuper or default investment option within a fund like Australian Super or Australian Retirement Trust, you might be paying excessive fees that eat into these tax savings. You need to look at choice or member direct options. For balances over $300,000, many funds offer admin fee caps. This means once your balance hits a certain point, the percentage-based fee stops and becomes a flat dollar amount. If you aren't using a fund with a fee cap, you are paying thousands of dollars for the privilege of them doing nothing extra for you. Check your statement tonight. But do you know the absolute worst thing the ATO can do to you? If you calculate your income incorrectly, we are going to look at the Division 293 nightmare in a second. But first, remember that timing is everything. The BPAY death trap is the #1 reason tax deductions are rejected every year. The law is crystal clear. The money must be received by the fund by June 30th. It does not matter when you sent it. It does not matter if your payroll department promised it was done. If that cash is sitting in a clearinghouse or a bank queue on July 1st, your deduction is gone, vanished, and you'll have to wait another 12 months to claim it. You should be making your final contributions by June 20th. At the absolute latest to be safe. Now, let's address the heavy hitters. If your adjusted taxable income exceeds $250,000, you enter the world of Division 293 tax. This is an additional 15% tax on your concessional contributions. Many people hear this and think, why bother with super then? Listen closely, because this is where the amateurs quit and the wealthy win. Even with Division 293 tax, your total tax rate on that money is 30%, compared to the 47% you would pay in your own name. You are still 17% ahead. Don't let the extra tax headline scare you into making a suboptimal financial decision. 17% of $30,000 is still $5,100 in your pocket instead of the government's. Before we reveal the final compliance trap, let's pause for a moment of reality. This is general information only, and does not constitute personal financial, taxation, or legal advice. The rules around the transfer balance cap and indexation are complex and change frequently. Always verify your specific situation with a professional who knows your full financial picture. Now, for the $16,500 trap I promised. It's the notice of intent failure. If you make a personal contribution to your super fund and want to claim a tax deduction, you must lodge a specific form with your fund and receive an acknowledgement before you file your tax return. I have seen high-income earners put $50,000 into their fund using catch-up rules, claim the deduction on their tax return, and then get audited because they forgot that one piece of paper. The ATO disallows the deduction, retaxes the $50,000 at the top marginal rate, and adds interest and penalties. It can easily become a $16,000 mistake overnight. You must ensure your fund sends you that confirmation letter. Keep it like it's made of gold. Because it is. If the thought of losing this much money this EOFY makes your blood boil, you are in the right place. Our next episode drops this coming Thursday at 7 p.m. And we are going to expose how certain retail funds are hiding commissions in their platform fees. That could be costing you a year of retirement. Make sure you hit that subscribe button for Aussie Super Secrets and turn on notifications. Don't give the ATO or the big funds a single cent more than you legally have to. I'll see you in the next one. Stay wealthy. Disclaimer: the information provided in this video is for general educational purposes only and does not constitute financial, taxation, legal, or home loan advice. It has been prepared without taking into account your personal objectives, financial situation, or needs. Before acting on any information, you should consider its appropriateness and consult with a licensed professional, such as a financial planner or tax agent. Specific results or future performance are not guaranteed. Copyright symbol 2026 Aussie Super Secrets. All rights reserved.